All right, so let's begin the show with an NFO, and here I'm talking about Union AMC's Active Momentum Fund. NFO is on till 12th December where you can invest, but then what exactly is this category and why should an investor be looking at an Active Momentum Fund, which is factor investing in a way is actually catching up. So let's discuss more on this. I have Harshad Patwardhan, CIO Union AMC with me. Harshad, hi, good evening and welcome to the show. All right, so before I get into the nitty-gritties of this Active Momentum Fund, I want to understand, or I want your help to help I want you to help our viewers understand this particular category in factor investing. That's really catching up among investors. You're talking about momentum strategy, and here we are talking about an active momentum strategy. What do you exactly mean by that?
Firstly, Kavita, thanks for having me. So if you look at the empirical evidence, it suggests that in factor investing, momentum is one factor that both in terms of frequency and in terms of extent has done very well compared to the broader markets. If you look at the 14-year data, only 3 times it has underperformed the broader market. And it has found itself in number 1 or number 2 position maximum number of times. And that is, we are talking about passive momentum. What we are trying to do through Union Active Momentum Fund is to productize this insight for investors in an active form. We believe active momentum strategy will do even better, and that's what our backtesting suggests, better than the passive momentum strategy. In active momentum, in a sense, if I have to say it in 2 sentences, on the buying side, it is rule-based, disciplined buying. And on the selling side, we want to be swift and opportunistic in selling to deliver, performance for our investors.
All right, Harshad, so when we talk about active momentum, what's the kind of exposure and element of risk that we are talking about? And is it right to say that the strategy would incur more volatility for an investor?
So let me differentiate between passive versus active. It's very important. There are quite a few passive funds in the market already. In passive momentum strategies, what happens is you do rebalancing of the portfolio twice a year. In active, one of the differentiating factors is that we do it at least once a quarter. But we have an option of doing it more number of times. And the reason why it is important is because the market complexion, market texture can change depending on the events that may happen geopolitically outside of India or inside of India. And we have an option to do it often. So in a way, momentum strategy wise, you want to be in stocks which are leading in terms of momentum score. Active portfolio can be more current. The only intervention that we do on the buying side is that we test each of those stocks for liquidity, because in this strategy, you want to minimize the impact cost, both on the way in and way out. On the selling side, as I said, one of the key things is that you have to be very swift in selling. Now, even between the 2 rebalancing days, let's say if there is a accident that happens in a particular stock, let's say a regulatory stricture and so on, we are not going to wait for exiting from that stock to the next rebalancing day. Similarly, if there are any big incidents that happen, market-wide incidents, we can quickly act, particularly in terms of exits. So in these respects, we believe that there is a big improvement over passive strategy as far as our active strategy is concerned. You are absolutely right. Your second question, that in terms of volatility of returns will be on a higher side, both with respect to the broader markets as well as with respect to passive strategies. So standard deviation of returns is high, but we believe, and we have done that and it's there in our presentation, the higher volatility is more than offset by the higher returns that you tend to generate. So if you look at the Sharpe ratio of this strategy at our Union Active strategy versus passive strategy and broader markets, it is on a higher side. So yes, higher volatility, but more than compensated by higher returns.
Sure. Harshad, the last question to you. What kind of investors should invest in this kind of a fund then?
So it's very important to understand that, the fund manager will be very active in this. So we will do rebalancing. which will lead to 30-40% of the portfolio possibly changing every time you do the rebalancing. That's what our backtesting results suggest. So there is a lot of action that will happen at the fund managers level, but we believe that investors who have the patience to be in this fund for 3 to 5 years, I mean, ideally 5, but bare minimum 3, are the kind of investors who should participate. These investors should be the ones who have experienced markets, so they are not spooked by volatility that is bound to happen. But if somebody wants to fully benefit from this strategy in terms of delivery of returns, it's very important to have a long-term time horizon of 3 years, ideally 5.
All right, I think with that, thank you so much for being on the show, Harshad, and helping our viewers understand not only the category, but then the reasons why they can have this kind of an exposure in their portfolio. Thank you so much.
If you like this video, then like, share and subscribe to ET Now.